Hi, everyone, and welcome to today's webinar on mastering multi-leg algos. I'm Zheng Phan, Head of Technical Product here at Talos, and I'm joined by my colleague Neelabh Dixit, our Head of Product Strategy. Together, we've spent the last few years working closely with our clients and our engineering teams to design and refine the multi-leg execution tools that we'll be showcasing today. We're excited to cover a topic that's becoming increasingly important in the crypto market as it matures and the complexity grows. Here's a summary of what we'll cover today. First, we'll break down the basics of multi-leg algos, what they are, and why they matter. Then we'll walk through the different use cases that are especially relevant in crypto. And finally, we'll do a demo and deep dive into the various strategies that Talos offers, how they work, and when to use this strategy, and how to configure them based on your trading goals. Now, before we go into the details, let's take a brief moment to step back on why execution efficiency matters. As you know, crypto markets are very volatile, and they're fragmented across different venues, and they operate 24/7 with constant shifts in pricing and liquidity. In this kind of environment, execution efficiency isn't just essential, right? It's the difference between edge and exposure. Slippages, timing mismatches, and poor leg handling can wipe out your opportunities quickly. So our multi-leg algos are built to solve exactly that, by giving you the ability to manage complex strategies across instruments and venues, whether you're chasing spread arbitrage or managing delta risk. Now, with that in mind, Neelabh, could you talk us through some of the most common use cases for multi-leg trades in the crypto markets?
Thanks, Zheng. Yeah, sure. I think for this discussion, I would cover mostly the use cases that don't involve options, because there are plenty of strategies around options, but we can cover them in a separate session. I will only cover the linear instruments. So the first and foremost is cross-venue arbitrage, meaning that simultaneously you are buying and selling the same pair across two different venues, or it could be exchanges, it could be liquidity providers. And if I as a user notice a consistent price efficiency across two venues for the same instrument, then they can execute a spread trade where they can enter a long position on the cheaper venue, and simultaneously they can enter a short position on the one that is trading at a premium. The second common use case is around trading correlations. So traders looking to execute a delta neutral or a market neutral strategy, they can they can match a long position with a short position in two different cryptocurrencies which have a high correlation. And for example, consider there's a coin A and coin B, which have a high correlation of 0.97, and the coins deviate from their historical trending in the short term, and the correlation becomes 0.4. So at this time, the arbitrage trader might want to take a dollar matched long position on underperforming, which is cheaper, and a short position on the one that is trading higher, with an assumption that they will revert to the mean. Similarly, you can actually tap in better liquidity to a two hop. So meaning that, let's say, if I am a fund or if I am a trader who has a position on Bitcoin or Ethereum, and they want to rotate this position to Solana, at the moment, there are not finding the direct pair liquidity is difficult. But if you can use a multi-leg to use, let's say, BTC USDT on leg one and Sol USDT on leg two, then you can actually roll this risk through just one execution. The other common use case that has been growing over the years is around cross currency. So let's say if you are quoting in JPY or in some other non-USD market, you're trading, let's say, BTC USD, and you're quoting BTC JPY. You can, if you have access to JPY USD and BTC USD, which is highly liquid, you can actually construct a better pricing and more liquidity to offer on BTC JPY. The most heard of trades in crypto are basis trades, because of just the leverage that has been into the system over each cycle, which are also called cash and carry trades. Effectively, you are just trading the time difference on a forward curve, which is basically you're buying a future. Let's say if a future is trading at a premium, you're buying the spot and selling a future, or if it is trading at a discount, you're doing just the opposite, with the expectation that at expiry the future price will converge to spot and you capture that the spread. The other interesting use case is on the spot markets. As a dealer to facilitate clients, you can actually use these multi-leg algos to build in, like to find the best hedge to price and basically for both pricing and hedging facing your clients. For an instance, in a contango market where futures are trading at a premium versus spot, if if for a dealer a client is selling, the trader can show a competitive quote in line with spot market, but they can hedge with futures or perpetual contracts that are trading at a premium because of this contango and make more spread, uh, and vice versa. So outside this, like people also like do a lot of staking. So if you want to do a mixture of like delta neutral and yet staking, you can do something like you you use your capital, you use your USD to buy the coin that you have to stake, then use a portion of that coin as a margin to sell the perps for the same dollar notional that you have bought this overall coin for, so that you have no market exposure, and then the leftover asset that you were not using as margin you can stake. So you can, if the basis is negative, meaning sorry is positive, meaning if futures are trading higher than spot, then you can actually collect both the basis as well as the staking yield. So I think I've talked about a lot of strategies and use cases, and they are quite prevalent in crypto markets just because of the state it is. As I said, we can talk about option strategies in a separate session. There are plenty that we can cover in a later time. I think with this background, it would be good to have a demo of like and to dig deeper into the algos that we offer on the multi-leg.
Great, thank you, Neelabh. Those are amazing insights. And just before we dive into the demo, I just want to talk very briefly about one very critical factor when it comes to multi-leg and spread trading in particular, and that's latency, right? Now, when we're executing across multiple venues, every millisecond counts, right? Price movement can quickly erode any of the spread you're targeting, and delays in the auto routing or the fields confirmation can introduce unnecessary risk. So at Talos, we work very closely with our clients to determine what the best hosting strategy is for our clients based on their trading needs, whether it's co-locating your infrastructure or deploying instances closer to your key venues. So this level of flexibility is especially important for firms that are running low latency strategies. And even looking ahead, we're very excited to share that we'll soon be offering a new low latency connectivity solution. Right, this enhances both reliability and speed across venue connections. More to come on that, but it's a big step forward to making institutional grade execution even more seamless for our clients. The context in mind, let's dive into the demo. I'll start sharing the screen and cover some of the multi-leg strategies that we've talked about. Right, on your screen right now, you see the Talos application, and you can see right now we're showcasing a list of market cards that are showcasing the different multi-legs we've talked about. But first and foremost, let me show you to the spot tab. Here you can see you're showing what we call our spot market data card, showing liquidity from Coinbase and also an aggregation of OTC and exchanges. Similarly, we support trading across different perpetual swaps on multiple venues, as well as futures. And we can combine any of those instruments into the multi-leg that we'll talk about right now. On the top left, you can see right now we have what we call cards showing you the spread between spot Bitcoin with a Binance perp. Clicking on this deep dive, you can see a more detailed screen showing you the synthetic order book of the spread between spot and perp, as well as the underlying markets. And you can see in this case, our clients is able to aggregate liquidity across different markets. Again, it can be across OTC and exchanges from spot versus perpetual. Similarly, Neelabh talked about basis trading. We can do this cross-exchange arbitrage as well between, in this case, Binance and OKX perp, or in this case, a cash and carry trade on Deribit between a future and a perp. And for trading across correlation between coins or creating synthetic crosses, you can see here we're trading ETH versus BTC through the dollar. Now let's go into the actual execution and how you create the different multi-leg using specific strategies. I'm just going to click one of these big figures here on the Binance versus OKX perp. we're mainly going to focus on 3 strategies today. You can see there's multi aggressive, we'll have a TWAP as well, and we'll focus on opportunistic passive. So what are these strategies? Let me just select a TWAP. It's very similar to your outright TWAP, and it's commonly used by traders when they want to get a schedule-based execution that trades over a specific duration of time. Our TWAP here will prioritize passive fills. What that means, you'll send crossing orders only when it's behind schedule or when it's or due to leg imbalance. So this shows that my traders in markets where the spread is fairly steady and the both legs are also liquid, right? So the traders just want to passively build up position, but with a time scale. You can see here that the spread is currently around minus 35 offer. I can put in a limit price here. I can make this more aggressive for this demo so that we see that it starts filling. Before that, just a quick note on terminology. When specifying a limit price here for multi-leg TWAP, it's really more of a target spread than a firm limit on the average price. And this is because when targeting multiple legs, there can be slippages or timing mismatches. And this algo works to try and stay within your defined target spread here. And it tries to actively maintain this while managing execution risk. For example, for this TWAP, when it's posting a resting level on the initiating leg, it's based on the available liquidity on the hedging leg, as well as this limit price you are specifying. So the algo will start posting sizes on the initiating leg to stay within schedule and willing to hedge at market to drag the lagging leg, the hedging leg, if the imbalance is outside the bounds you define. So bounds, if you look below, is one of the parameters. And if you look at our API docs, it talks about the percentage ahead or behind is willing to fall or go ahead in terms of schedule, and also how much leg tolerance, so how much leg risk you're willing to take when hedging. Here, for example, we can put in a 3-minute TWAP. I can start putting in like a large order, maybe here at 50 BTC with a limit price, place by order, and the order you can see on my top right here. We'll start executing. Clicking on the little chart icon, we have real-time TCA showing you the progress of this order and the fill amount on the individual legs. I'll close this for now, and you can see in the plotter at the bottom here, there's a little blue bar indicating this order keeps on working. Next, we're going to talk about the multi-leg aggressive strategy. So this is when traders are willing to give the algo more time than a fixed schedule to work towards a desired spread, but don't want to run leg risk. They prefer using this strategy. So here, the traders are flexible to absorb slippage as the hedge order are not restricted by the target price. So I can put an aggressive price in here. We can see the spread. If I put an aggressive price, they should fill pretty much immediately, as you can see, as and when liquidity is available. If you click on the details, if you look at the analytics on the legs, we can see that it's being aggressive, and you're getting taker fills on the legs as well. The next strategy I'm going to talk about is the multi-leg opportunistic passive. So this is when traders are willing to give the algo both time as well as delta and balance risk to target the desired spread. This algo initiates the leading leg as maker only, and depending on the risk appetite, the user can choose a time window and delta and balance in between the legs until they want the hedging to be passive before it turns aggressive. There are different parameters here that we'll talk about in more detail. And the traders, in this case, is going to be flexible to take certain amount of risk and willing to pay extra to hedge. So for example, here, I'm putting in a order for, say, 100 BTC. The market is minus 2036. I'm going to be a bit more passive, right? I'm going to put 100K leg imbalance. I'm putting in 30 seconds, passive timeout, and 5 bits paid extra. And I'm going to go. In this case, we can see the order is waiting, and it will start filling once it gets able to get a passive fill on the leading leg. So now I've gone through the strategies. Neelabh, do you want to talk a bit about which strategies a trader would commonly choose depending on their trading goals, and a bit more details about each parameter?
Yeah, sure. Like the question about parameters, usually it's a question of the trader's view on the liquidity of individual legs, the view on the volatility of the spread between the two legs, and the risk that they are willing to run, both in terms of the time risk as well as the delta imbalance. in order to allow the algo to work on the spread for the desired target spread. So there is no one answer that fits all. Two different traders at the same desk might choose different algos with different parameters, or the same algo with different parameters, and because of that, like they might have like completely different sort of execution. But I will basically we I will cover these parameters and just like how users think. So starting with the foremost, like the most important parameter, which is initiating decision. Usually, the initiating decision, like amongst the two legs or both legs, it's a choice of which leg to initiate, and it is typically based on the liquidity. It's a combination of liquidity, trading fees, and if there are any system constraints, meaning that like if if a venue supports post only or doesn't support post only orders, those type of things. But in most of the cases, the less liquid leg is preferred for initiation, while the more liquid leg is preferred for hedging. But lower trading fees, if you are trading in venues where you are collecting fee, being a maker, that can also influence the decision, making a particular instrument the preferred initiating leg, even if the liquidity is comparable or slightly lower. Additionally, if a venue does not, as I highlighted, additionally, if a venue does not support posting orders or enforces some sort of tight rate limits, then again, this is also a parameter you need to optimize while thinking about the initiating leg, because then rapid order posting and cancellation will be difficult, and making it will make it less suitable for that leg to be the initiating leg. The other important parameter is the max imbalance, which is a parameter which is available like in the algos. Both is it's a required and mandatory parameter both on aggressive and passive opportunistic algos that you talked about. It's effectively it sets a USD threshold for how much one leg can get ahead of the other, how much the initiating leg can go ahead of the hedging leg, and it defines the clip size across your child orders as well, factoring in traders slippage tolerance. So, for example, if on a 50K order, a trader might set 2.5K max delta imbalance, ensuring that they get at least 20 child orders for controlled execution. It's again an optimization balancing between the execution speed, market impact, and the risk management. A tighter max imbalance ensures smoother execution with lower risk, lower slippage expectation on overall, but that may slow down the fill rate. While if you have a higher imbalance, it will allow for faster execution whenever the market has opportunities, but it will have bigger, like more risk of slippage. So it comes with the cost of increased market impact. Um, Now, moving to passive opportunistic, outside of max imbalance, it has few other parameters that you highlighted when you were posting the orders. The first one is hedge passive timeout. So effectively, it it is the time window during which the strategy hedges passively before shifting to aggressive hedging, and the timer starts and resets with each new fill on the initiating leg, allowing traders to control how much time risk they are willing to take in pursuit of a passive or a maker fill on the hedging leg. So, again, different traders might have a different view in terms of how much time risk they are willing to give their algo in order to prioritize uh, passive fills. And beyond that, they want the hedging to get aggressive, meaning that if until that duration, even if the market is in your favor, the algo will try to keep posting on top of the book so that you can get a passive fill. But beyond this time, it will go aggressive. So if the current market, like basically, if the hedging price is marketable, then the system will go and cross beyond this time. The other parameter you highlighted here is hedge pay extra. So the opportunistic multi-leg strategy, it operates by allowing the initiating leg to continue executing until it exceeds the max imbalance threshold that was set by the trader. that they are willing to take between the two legs. With each fill on the initiating leg, the system attempts to hedge the lagging leg passively as a maker within the hedge passive timeout window, and beyond that, it gets aggressive. However, if the system cannot fully hedge within this time, and it cannot hedge further even after it has shifted to aggressive hedging, like playing within the constraints that you have like entered as your target spread. Uh, if the initiating leg surpasses the max imbalance threshold and the system has exhausted both passive and aggressive hedging attempts within the target spread that you have entered as a user for that order, then the hedge pay extra parameter gets activated. It's in simple terms, it it is the extra slippage that the trader is willing to pay to fully flatten the leg risk once both time, which time risk that you have entered in the form of hedge pay, in the form of passive timeout, and the the delta risk that the trader was willing to pay uh, have been reached. So it in short, like it's the amount of slippage that the user is willing to pay once the algo has hit both the time and delta imbalance risk limits that they were willing to take. The last uh, parameter around passive opportunistic, which is an optional, that's why you didn't include that in the order, is market hedge trigger. So this is an additional parameter that is like useful for certain type of traders. Uh, it's it's a parameter that allows traders to give an order enough time for the market to potentially return to favorable price levels while holding the leg risk. And there are different approaches. It's an optimization, but the different ways in which users think about it are the amount of P&L hit that they are willing to take in order to, or risk in order to get this desired target spread. At the child order level, the P&L hit a trader is willing to risk relative to the desired target spread will define, like will influence this decision. The other way to think about it is also in terms of implied volatility. And so applying a multiplier to the implied volatility of a time frame that the trader is willing to hold the risk for and the last way to think about it is also in terms of slippage tolerance. So the traders could consider the relationship between the target spread and the tolerable price to estimate how often the child orders will trigger a market hedge trigger. And so these are the three different parameters that they need to optimize for while making a decision for market hedge trigger. Uh, as I said like earlier, these are different tools to allowing a trader to exercise their view, but they need to like have a view on in terms of the liquidity on individual legs, the volatility of the underlying legs, as well as the volatility of the spread, and the amount of time and delta imbalance risk that they are willing to take in order to execute a trade. So not only understanding the parameters is important, understanding the market structure is also extremely important to execute these trades effectively.
Great. Thanks so much, Neelabh. And yeah, thanks to all of you who have joined us on this session. We really hope that this gave you a clearer picture of how multi-leg algos can be used to improve execution in complex and fast-moving crypto markets. At Talos, we're continuing to build tools that help traders not just keep up, but stay ahead. Yep. As we've discussed today, the traders need to have a strong understanding of market structure, risk management, and execution strategies. These aren't just technical details, they're essential to navigate these crypto markets. So for further information on Talos Multileg, please feel free to contact your Talos account manager or email sales@talos.com. Thanks for joining us. Thank you.